Retail traders chase indicators, banks move the market. If you want to stop trading like the crowd and start thinking like smart money. This is the knowledge they don't want you to ignore. Most traders are taught the market is a place where price moves because of indicators, patterns, or news. They are trained to believe that price reacts randomly and that success comes from predicting the next move better than others. This belief is the first trap. Large financial institutions do not operate on predictions. They operate on liquidity. Liquidity is the fuel of the market. Without it, large positions cannot be entered or exited efficiently. When institutions place trades worth millions or billions, they cannot simply click buy or sell like a retail trader. If they tried, price would move aggressively against them, increasing their cost and exposing their intentions. So instead of predicting price, they focus on where liquidity exists. Liquidity exists where retail traders place stop losses, breakout orders, and pending entries. These are commonly found above obvious highs, below obvious lows, around trend lines, support, resistance, and popular technical levels. This is not accidental. Retail education has conditioned traders to behave in predictable ways, and predictable behavior creates accessible liquidity. When price approaches these zones, it is not random volatility. It is the market being guided toward pools of orders. Price moves to collect liquidity, not because an indicator crossed or a candle pattern formed. This explains why price often breaks structure only to reverse, sweeps highs or lows and instantly rejects, moves aggressively into obvious levels before changing direction, triggers stops right before a major move. These are not mistakes. They are mechanics. Institutions require opposing orders to fill their positions. To buy large quantities, they need sellers. To sell large quantities, they need buyers. Retail traders unknowingly provide this by placing stops and breakout orders at obvious locations. This is why price is often pushed against the majority before the real move begins. Think of the market as an auction engineered to extract orders. Price is the tool used to reach those orders. Once enough liquidity is gathered, the market can move efficiently in the intended direction. This also explains why price can ignore news or move in the opposite direction of expectations. News does not create direction, it creates volatility, which helps access liquidity faster. The move itself was planned long before the headline appeared. Retail traders ask, why did price reverse there? Why did my stop get hit first? Why does this happen every time? The answer is simple. You were positioned where liquidity was needed. Understanding this changes everything. The goal is no longer to predict. The goal becomes alignment, learning to see where liquidity sits, and waiting for price to show that it has collected what it needs. When you stop thinking like a participant and start thinking like a liquidity provider, the market becomes clearer. The chaos begins to make sense. What once felt manipulated now feels mechanical. The market is not against you personally. It is simply doing what it must do to function at scale. Retail traders are often overloaded with indicators, oscillators, moving averages, signals, alerts, all designed to give certainty in an uncertain environment. The problem is not that indicators are useless. The problem is how they are used. Indicators react to price. Institutions do not react, they position. Smart money focuses on zones, not signals. A zone is an area on the chart where significant transactions previously took place. These zones represent imbalance, accumulation, or distribution. They are areas where price moved aggressively because large orders were executed. When price returns to these zones, reactions often occur. Not because of magic, but because unfilled orders may still exist. Indicators give answers after the fact. Zones exist before price arrives. This is a critical difference. Institutions plan trades in advance. They identify areas where price is likely to react based on previous activity. Market structure and liquidity positioning. When price reaches these areas, they do not jump in emotionally. They wait for confirmation through behavior, not signals. This is why smart money trading looks slow, patient, and selective. Zones are often formed after strong impulsive moves, sharp rejections, breaks of structure, consolidations followed by expansion. These areas mark where control shifted. When price revisits them, it is revisiting a battleground. Retail traders rely on indicators because they are searching for certainty. Institutions rely on zones because they understand probability. An indicator might say, buy or sell. A zone asks a better question. What is price doing here? Is price slowing down? Is liquidity being swept? Is structure shifting? Is there rejection or acceptance? These questions are far more important than overbought or oversold readings. This also explains why indicator-based strategies often fail during high-impact moves. Indicators lag, zones do not. Smart money understands that price does not move from point A to point B in a straight line. It moves in phases: accumulation, manipulation, expansion. Distribution zones help identify where price is within these phases. Retail traders often enter during expansion, the most emotional phase, because indicators finally confirm the move. Institutions often entered earlier, during accumulation, when price was quiet and boring. This is why patience is a competitive advantage. Trading zones requires waiting. It requires discipline. It requires accepting that not every move is yours to trade. But when price reaches a high probability zone, the risk to reward becomes asymmetric. Indicators encourage activity. Zones encourage precision. Another key difference is that indicators look the same to everyone. Zones are interpreted through context. This is why smart money strategies cannot be fully automated or reduced to a single signal. Context matters. Where is price relative to higher timeframes? Has liquidity been taken? Is price expanding or contracting? Who is trapped? These answers cannot be found in a single indicator. When traders shift from indicator dependence to zone awareness, they stop chasing price. They stop reacting emotionally. They begin waiting for price to come to them. This mental shift is what separates consistent traders from frustrated ones. The market rewards those who wait at the right locations, not those who click the fastest. One of the most painful experiences for traders is getting stopped out, only to watch price reverse immediately and move in the original direction. This moment feels personal. It feels unfair. Many call it manipulation. But in reality, it is something far more systematic. It is a liquidity hunt. A stop loss is not just protection. In the market, a stop loss is also an order. When a buy position is stopped out, it becomes a sell order. When a sell position is stopped out, it becomes a buy order. Multiply that by thousands of traders placing stops in similar locations, and you have a massive pool of executable orders sitting in plain sight. These pools of orders are liquidity. Liquidity hunts are not random spikes. They are deliberate movements designed to access these pools so that large positions can be filled efficiently. The market does not hunt traders, it hunts orders. Retail traders are trained to place stops in logical places, below support, above resistance, under recent lows, over recent highs, just beyond trend lines. From a protection standpoint, this makes sense. From a liquidity standpoint, it makes these locations predictable. Predictability is the problem. When price approaches an obvious high or low, it is often not because the market wants to continue. It is because it needs to collect what is sitting there. Once those orders are triggered, the market suddenly has the fuel it needs to move away. This is why stop-loss raids often happen right before a major reversal, during low liquidity sessions, at session opens, around news events. Near higher timeframe levels, the goal is not chaos. The goal is efficiency. Large players cannot enter or exit trades without counterparties. Liquidity hunts provide those counterparties in bulk. Retail stops, breakout traders, and emotional entries all contribute to this process. This also explains false breakouts. Price breaks above resistance. Breakout traders rush in buying. Stops from short sellers are triggered. Liquidity floods the market. Once enough buying pressure is absorbed, price reverses sharply because the purpose of the move has already been fulfilled. To the untrained eye, this looks like a failed pattern. To a trained eye, it looks like a successful liquidity grab. The most important mindset shift is this: price does not move to reward or punish. It moves to facilitate transactions. When traders place stops without understanding where liquidity is concentrated, they place themselves directly in the path of these hunts. This is why tight stops near obvious levels are frequently targeted. Understanding liquidity hunts changes how you manage risk. Stops are placed with intention, not convenience. Entries are delayed until liquidity is taken. Confirmation is waited for after the raid, not before. Instead of asking, "Where should my stop be?" the better question becomes, "Where are most stops likely sitting?" Once those stops are cleared, the market often reveals its true direction. The raid is not the move. The move comes after the raid. This is why patience is essential. Entering before liquidity is taken means competing against larger forces. Entering after liquidity is taken means trading with momentum that has purpose behind it. Liquidity hunts are not enemies. They are signals. They tell you where the market has been and where it is likely to go next. If liquidity hunts explain why price moves, order blocks help explain where it is likely to react. An order block is not a magical candle. It is not a pattern to memorize. It is a zone that represents significant, unfilled orders left behind after a strong move. When price moves aggressively in one direction, it often does so because large positions were executed. However, not all orders are filled at once. Some remain pending. These unfilled orders become areas of interest when price returns. That area is what traders call an order block. Order blocks form at the origin of impulsive moves. They are usually found just before a strong expansion in price. The market pauses, accumulates, then launches. That pause is not random, it is positioning. When price later revisits that area, reactions occur not because of coincidence, but because business is unfinished. This is why order blocks are best understood as footprints. They show where large players previously committed capital. And just like footprints in the sand, they tell a story of intent. Retail traders often chase price after the expansion. Institutions often wait for price to return to the origin. This difference in timing is critical. Order blocks are not about catching tops or bottoms. They are about identifying areas where risk can be defined tightly and reward can be expanded. They offer asymmetry. However, order blocks do not work in isolation. Context matters. Has liquidity been taken before price returns? Is price approaching from premium or discount? Is the higher time frame aligned? Is there confirmation of rejection or acceptance? Blindly trading every order block leads to frustration. Understanding why an order block exists leads to clarity. Another mistake traders make is assuming order blocks must hold every time. They do not. If an order block fails, it provides information. It may indicate that orders were fully filled earlier or that market conditions have changed. Failure is feedback. Order blocks work best when combined with market structure shifts, liquidity sweeps, strong displacement, higher time frame bias. When these elements align, order blocks become high probability areas, not because they predict the future, but because they reflect past commitment. This is the key distinction between retail tools and institutional concepts. Retail tools try to forecast. Institutional concepts track behavior. Order blocks also explain why price respects levels that seem invisible to most traders. There may be no obvious support or resistance, no indicator alignment, no pattern, yet price reacts sharply. That reaction is not random. It is memory. The market remembers where large transactions occurred. It revisits those areas when conditions allow. And when it does, the reaction can be swift. Trading order blocks requires patience and selectivity. Not every chart will offer a clean one. Not every session will return to one. But when it does, the opportunity is often clearer than chasing momentum. Instead of asking, "What is the signal?" the question becomes, "Where did price last move with intention?" That is where institutions left evidence. Most traders are taught to see market structure as a simple sequence of higher highs and higher lows, or lower highs and lower lows. While this definition is technically correct, it is dangerously incomplete. Market structure is not just a description of trend. It is a tool used to condition behavior. Structure teaches traders when to feel safe. When price makes a series of higher highs and higher lows, traders are taught that buying is confirmed. When price breaks a low, traders are taught the trend has changed. These lessons create confidence, and confidence creates exposure. That exposure is exactly what the market needs. Market structure is often engineered to invite participation before reversing. This is why price frequently shows perfect structure just before trapping the majority. The cleaner the structure looks, the more traders commit. Traps are not accidents. They are consequences of crowd behavior. Consider how often pricey breaks structure and immediately fails, forms a strong trend only to reverse sharply, gives a textbook breakout that collapses, confirms a reversal, then resumes the original direction. These events are not flaws in structure. They are uses of structure. Retail traders trade confirmation. Confirmation requires time and visibility. By the time structure confirms, the majority is already positioned. That positioning creates liquidity. This is why the market often breaks structure twice. The first break invites belief. The second move reveals truth. The initial break of structure often acts as a liquidity engine. Traders rush in expecting continuation or reversal. Stops are placed logically. Once enough orders are built, price can move efficiently in the opposite direction. This is why experienced traders wait for failed structure. Not just structure breaks. A failed break tells a deeper story. Liquidity was taken, participation peaked, commitment shifted. True direction often begins after traders are convinced they are right. This also explains why trends feel easy in hindsight, but chaotic in real time. Structure is clearest at the moment it stops working. Retail traders see structure as a signal. Smart money sees structure as a map of positioning. When price moves up, the question is not, is the trend bullish? The real question is, who is buying and where are their stops? When price moves down, the question is not, is the trend bearish? The real question is, who is selling and how exposed are they? Traps form where belief is strongest. Understanding this changes how structure is used. Instead of chasing clean breaks, the focus shifts to where structure looks too obvious, where everyone agrees, where risk appears minimal. Low risk for the crowd often means high risk for late entries. Market structure is not lying. It is simply incomplete when viewed without liquidity context. When structure aligns with liquidity being taken, the move has purpose. When structure forms without liquidity, it often becomes a trap. The market does not punish retail traders for being wrong. It punishes them for being predictable. One of the biggest misconceptions in trading is the idea that large players enter a position at a single price point. This belief comes from retail execution, clicking buy or sell and instantly being filled. Large positions do not work that way. Institutional execution happens in phases. A single order of significant size would immediately move price, increase slippage, and expose intent. To avoid this, entries are broken down into multiple pieces and executed over time. This is why price often consolidates before major moves. Consolidation is not indecision. It is position building. During these phases, price may move sideways, create false breakouts, or fluctuate within a range. To impatient traders, this feels like a bad market. To experienced traders, it is a signal that something is being prepared. Phased execution usually follows a sequence: accumulation or distribution, liquidity manipulation, expansion, rebalancing. During accumulation, price appears stagnant. Volatility is low. Traders lose interest. This is intentional. Low attention reduces competition and emotional participation. During manipulation, price is pushed toward liquidity. This creates false signals, stop runs, and emotional reactions. The goal is not direction. It is order flow. Once sufficient positioning is complete, expansion begins. This is the move everyone sees. By the time it starts, most of the position is already built. Retail traders often enter during expansion. Institutions often finish entering before it. This difference in timing explains why retail traders feel late and stressed, while institutions feel calm and in control. Understanding phased execution also explains why price revisits levels multiple times, entries seem missed, but come back. Clean setups appear after chaos, patience is rewarded, price is not bouncing randomly. It is rotating to allow completion of orders. Another critical insight is that exits also happen in phases. Large positions cannot be closed instantly without disrupting price. Distribution happens gradually, often while the trend still looks strong. This is why markets can trend while large players are already reducing exposure. Retail traders often believe trends end suddenly. In reality, they end quietly before the collapse becomes obvious. This phased approach means that one candle does not represent a full decision, one breakout does not represent full commitment, one pullback does not mean weakness, everything happens in layers. This is why smart traders avoid all-in thinking. They understand that markets operate on scales larger than individual emotions. When traders align with phased execution, their behavior changes. They stop chasing single entries, they scale in its zones. They wait for confirmation after manipulation. They hold through noise with intention. Instead of asking, "Did I miss the move?" the question becomes, "Is the move still being built?" Most of the time the answer is yes. Most traders believe news is the reason markets move. Interest rates, economic data, policy decisions, surprise headlines, these are assumed to be the triggers that create direction. This belief keeps traders glued to calendars, waiting for announcements, as if price will suddenly decide where to go once the news is released. But in reality, news rarely creates direction. It accelerates moves that were already prepared. Markets do not wake up and choose direction in a few seconds. Large positions require time, planning, and liquidity. That planning happens quietly, long before headlines reach the public. By the time news hits, positioning is often already in place. News provides permission, not intention. High-impact events inject volatility into the market. Volatility means faster price movement. Faster movement means easier access to liquidity. That is why news is so valuable. It allows the market to move aggressively without raising suspicion. This explains why price often moves in one direction before the news spikes violently on release, then reverses, ignores good or bad data entirely. Traps both buyers and sellers within minutes. The headline becomes the distraction. The real objective is execution. When news is approaching, liquidity builds. Traders place breakout orders, stops tighten, speculation increases. The market becomes crowded with expectations. That crowd is the fuel. At release, price may spike upward, triggering buy stops and breakout entries. Seconds later, it may reverse sharply, wiping out late entries and stops. To emotional traders, this feels like chaos. To informed traders, it is simply liquidity being harvested efficiently. The direction after the dust settles is often the real move. This is why trading during news is one of the fastest ways to lose consistency. The speed, slippage, and emotional pressure favor those already positioned, not those reacting. News also explains why markets sometimes move opposite to logic. Strong data may lead to price dropping. Weak data may lead to price rising. This is not irrational, it is positioning being unwound or completed. If the market is already long, good news may be the excuse to sell into strength. If the market is already short, bad news may be the excuse to buy back positions. The narrative adjusts to the move, not the other way around. Understanding this shifts how traders view news. It is not a signal. It is not an entry trigger. It is not a prediction tool. It is a volatility event. The most effective approach is observation, not reaction. Let the initial spike happen. Let liquidity be taken. Let price reveal acceptance or rejection. The real opportunity often comes after the emotional response fades. When traders stop trying to outguess news and start reading price behavior around it, their stress decreases and their clarity improves. News is loud. Execution is quiet. The hardest skill in trading is not analysis. It is patience. Most traders lose not because they are wrong, but because they are active. They feel the need to participate constantly. Every candle feels like an opportunity. Every pause feels like missing out. This mindset is encouraged by modern trading culture: alerts, signals, social media wins, constant stimulation. The result is overtrading, emotional fatigue, and inconsistent execution. Smart money does not trade often. It trades selectively. Large players wait for specific conditions. Liquidity has been taken, price is at a meaningful zone, structure aligns with intent, volatility serves a purpose. If these conditions are not present, nothing happens. This waiting is not laziness, it is discipline. Frequency creates noise. Noise hides mistakes. Patience exposes truth. Retail traders often confuse activity with productivity. They believe more trades equal more opportunity. In reality, more trades usually mean more exposure to randomness. The market offers only a few high-quality opportunities. Everything else is temptation. This is why patience is a skill, not a personality trait. It must be trained. It requires trust in a process, not in impulses. Patience also changes risk management. When traders wait for high-quality setups, they can risk less per trade, hold positions longer, avoid emotional exits, accept losses calmly. When traders force trades, everything becomes reactive. Following smart money means accepting boredom. It means watching price move without participating. It means letting others fight inside ranges while waiting for purpose to appear. This is uncomfortable at first. The urge to act is strong. But with time, restraint becomes confidence. Another aspect of patience is letting trades play out. Smart money does not panic over small retracements. It understands that noise is part of execution. Retail traders often exit too early because they expect immediate validation. Markets reward those who can sit through discomfort with logic. This does not mean holding blindly. It means understanding where the trade is wrong and ignoring everything else. Patience also protects psychology. Fewer trades mean fewer emotional swings. Fewer emotional swings mean clearer thinking. Clear thinking leads to consistency. The goal is not to trade every day. The goal is to trade when it matters. Many traders discover that when they reduce frequency, their results improve, even if their strategy does not change. This is because quality always outperforms quantity. Smart money waits for alignment. Retail traders chase movement. One acts with intention.